Good afternoon, everyone. Quick note before we get started, all details, including presentation materials, will be available at returnstackedetfs.com. You'll find information not only on the concepts from today's session, but also on the other ETFs in the suite, which cumulatively are well over $500 million as we chat today. Again, I appreciate everyone joining us. Good afternoon for those joining from Europe and the East Coast. Good morning for those from the West Coast. My name is Adam Butler. I'm the co-founder and chief investment officer at Resolve Asset Management Global and one of the PMs on the Return Stacked ETF suite. If you haven't heard of the Return Stacked suite of ETFs before, ultimately what this aims to do is unlock the benefits of diversification by allowing you to introduce alternative investment strategies and exposures into your portfolios without having to sacrifice coveted core stock and bond exposure. Now, what I want to highlight is that this is really not a new concept. This is something that's been used by institutional investors going back to the 1980s. It just was previously available to most investors, or it wasn't rather available to most investors in an accessible mutual fund or ETF wrapper. And that's why we're so incredibly excited about bringing this suite of ETFs to you today. Why do we think that this structure is so interesting? We believe that ultimately the potential benefits are numerous, but really what it comes down to is that historically, diversification has been this process of what I would call addition through subtraction, where we've had to sell things in our portfolio in order to make room for diversifying alternatives or asset classes, which increases not only the performance hurdle with which these alternatives need to overcome in order to add value, but also, in my opinion, introduces a really significant behavioral hurdle. And so first and foremost, this structure of return stacking allows investors to include diversifiers, whether those are diversifying asset classes like gold or long-term bonds, et cetera, or investment strategies into their portfolio without having to sacrifice their core stock and bond exposure. And that should significantly reduce not only the performance hurdle rate to include these diversifiers, but also help significantly on the behavioral side of the equation. Second, return stacking provides a really novel approach for investors who are seeking to generate excess returns. We've all seen the SPIVA reports and the Morningstar reports that suggest how hard it is for stock pickers to beat the market with better security selection. Return stacking gives us a way where we no longer have to fish in the same security pond as everyone else. Instead of trying to find alpha through stock picking, we can simply keep our stock beta, keep that large cap equity exposure, and then stack an alternative investment strategy on top and use that combination to try to beat the market over the long term. Finally, return stacking has the potential to improve internal portfolio diversification. The fact is, if we're thoughtful about what we stack and truly try to stack alternative diversifiers on our existing stock or bond allocation, it has the potential to reduce portfolio volatility and reduce portfolio risk. What we think really, again, makes return stacking so powerful is that it unlocks the one thing that people in this industry tend to agree on, which is that all else held equal, more diversification is better than less. If we can add more diversifiers to a portfolio, it not only has the potential to improve the certainty with which we achieve our outcomes, it might actually improve the outcomes too themselves. All right, if you have any questions during the session, please use the Q&A function in the webinar window and we'll try to either weave the answers into the narrative of the webinar or else we'll address them at the end during the Q&A. As a last item, a quick poll question. Who out there is already making use of return stacked ETFs, either in their own portfolios or in client portfolios? Please make a selection. Give you a minute to do that. Hopefully you've been reading through all of the disclaimers while I introduce the subject. All right. With that said, I am extremely pleased. Oh, we're at 50-50 in terms of people who've used the stacking suite before. Fantastic. So I'm extremely pleased to introduce my colleague, Rodrigo Gordillo, president, co-founder, and portfolio manager at Resolve Asset Management Global, to blow your hair back with the core content of today's session. Rodrigo, over to you.
Thanks, Adam. Thanks for that awesome intro and context to what we're about to walk everybody through today. I see people here from everywhere around the world: Europe, LATAM, Canada, US. Honestly, amazing to see the international interest that we're seeing on the return stack concept. As Adam has said, my name is Rodrigo Gordillo, President and Portfolio Manager of Resolve Asset Management Global. Also the co-creator of the return stack concept, along with our partner, Corey Hostin at Newfound Research. And we are also trading advisors for the Return Stacked ETF suite. So as Adam alluded to, we launched our first ETF in February 2023. And that was just 17 months ago. And we've garnered over, as of yesterday, July 22nd, 2023, just over $590 million. And to be a newcomer in the ETF space is really hard. It's especially hard to be a newcomer in the alternatives category of the ETF space. Just to put it into context, I remember hearing one of the alternative ETF launches in 2022 saying how proud they were that they were the fastest growing ETF at just over $50 million in their first year. And that was a huge accomplishment. The fact that we've gone from zero to just over 590 million without any outside money, no large call centers, no paid advertising, no access to wirehouses or mainstream media. I say this not to brag, but rather to highlight that we think this is a novel investment approach that thoughtful investors have clearly needed and we're excited to satiate that demand. And I also say this in hopes that everybody here today will have the opportunity to make a concerted effort to keep an open mind in terms of what we're going to show, and to allow yourself to sacrifice some of those sacred cows along the way. Because if you do this, if you have an open mind as I walk you through these concepts, I'm confident that you'll be just as excited about the opportunities that these prepackaged ETFs bring to your portfolios as I am. And as Adam walked through 3 important points here, I'm going to focus on that second point. Today, we're going to focus on the aspect of using return stacking to aim to outperform the market. So what we're going to really talk about is that the S&P 500, and really focus on stacking alternative strategies on top of the S&P 500 benchmark. But let's first take a step back and make sure that we're all on the same page when it comes to security selection. Adam alluded to SPIVA before. Let's drill into it. We were looking at a report here from SPIVA that goes back 15 years to identify the percentage of active US large cap managers that truly outperform that passive S&P 500 benchmark. And what we find here is that only 12% of active fund managers manage to do that. They manage to outperform. And of course, having seen the past and identifying that 12% of managers doesn't necessarily say anything about the likelihood that those same that 12% of managers, and their ability to outperform over the next 15 years. Right. So I'm looking at the SPIVA report, and a couple of months ago, I decided to do my own little digging and research. I wanted to go back even further, went back 20 years, and this time I used the Y-Charts database to source as many large cap US equity funds from February 2004 to February 2024, just to see how many of these managers truly outperform. And what we found was, it was shocking to me to only see 41 of them that outperformed the S&P 500 out of 3,200. And the median outperformance also was quite modest. It was 0.3% of quote unquote alpha. And what we found also in terms of consistency, right? When you're picking an active manager, when you're doing active security selection, what you really hope is that every year when you review your portfolio, you're looking at it and saying, did I do better than the index? Did I actually, all that hard work, did it translate into something important for myself, if I'm an individual investor, or my clients, if I'm managing money for them? And what we find that from this study is that it's a coin toss. If you were to have sourced those 41 managers, used them throughout this period, the median outperformance is about a coin toss. And in fact, the best fund only outperforms 60% of years, right? So it really does beg the question, given all of this information, all of the data, why do we keep fishing in the same overcrowded pond that everybody else is as we try to beat the market? Because when we look at all of that effort and all of that hard work, assuming we were able to pick the right managers, is it really worth it? Like, number one, can we count on this alpha in the future? And number two, is the tracking error, the lack of consistency, worth all the trouble? And the real question is if there's a way to sidestep this overcrowded pond and really find a much larger ocean of opportunities through a structural hedge. And to that effect, what I'm going to do is I'm going to go through a couple of case studies that I hope will resonate with you and help you understand this concept and see if you can apply it in your portfolios. And really, we need to first stop obsessing about beating the benchmark via stock selection and start transitioning our thinking by using the same concepts that institutions have used for years of that capital efficiency, that return stacking, in order to provide a different way to do it. And what I'm going to do in this first case study is I'm going to compare the returns of stocks and bonds to these factor investing strategies. These are, for those of you who are unfamiliar with stock selection by a factor investing, it really is just it's a fancy word for quantitative stock picking. And they do it through different styles, right? So at first you wanted to mimic what Warren Buffett did. You could use a quantitative method to select based on value metrics. And there's another style that's based on size metrics or momentum or quality or low volatility. These became really popular in the last couple of decades from academia. And then what we did is we've been applying them as an industry to see how well the academic evidence has played out in the last few years. Okay, so I'm going to walk you through this slide here because it's quite busy. The analysis here covers the period of August 2013 to August 2023. That doesn't cover the statistically significant period of the academic paperwork. It is the period by which we saw most of these factor ETFs and mutual funds be out in the market. So it allows us to evaluate the true out-of-sample, net-of-fee, live performance of funds that actually implement these factors. And it also allows us to identify and compare these factors during a period of investing where factor investing became hugely popular. Okay, so on the tops here, what we're going to show is the top three rows is the annualized return at the top, annualized standard deviation in the middle, and drawdown next to it. So a few important caveats here. The stock returns and the bond returns are the excess returns above T-bills. Okay, so we just want to know, if you didn't invest in cash, how much did stocks and bonds provide? And you can see that stocks outperformed cash by 11.8%, bonds by 0.3% during that period. But all the values after that for value, size, momentum, quality, and low volatility, all of these here are what excess return, the value, the size, and momentum, the quality, low volatility factors had above the S&P 500. And what we can see is that it was a tough go, right? Half of them underperformed, some of them momentum and quality outperformed by a slight amount. And they did it with moderate volatility, pretty significant drawdown similar to that of stocks or bonds. Now, one of the benefits here in that bottom part of this chart is the correlation, right? So if we're going to be doing something different than traditional large cap index investing, we're going to go through factor investing. We want to make sure that that pure factor actually has low correlation. And they did deliver on that, right? Correlations are really low, close to zero, low vol, negative 0.63%, which is quite significant. So great diversifiers, not so much on the return side. Now I'm going to introduce another factor that nobody really talks about, that during that same period, we saw a pretty significant outperformance above the S&P 500. So that was a 2.8% return, volatility of around 10%, drawdown of 21%. And what we want and need is that low correlation to stocks and bonds, right? So the mystery factor has done well with low correlation when we contrast it against that 0.3% security selection stack. 2.9 is quite significant. It can make all of the difference leading up to retirement, post-retirement, especially, let's be clear, the 13% annualized rate of return of the S&P 500 in the last decade is an outsized return. It is not what we should expect in the future given current valuation. So if we see a future where returns may be low on on just passive equity exposure, being able to stack 2.9% or anything above that will be useful, even more useful than it was in the last decade. Okay, so pretty good outcome for this mystery factor. Now, what is this mystery factor? The mystery factor is actually the managed futures trend following strategy that we stacked on top. Now, I'm not going to get into the nitty gritty of managed futures trend. If anybody here doesn't know what that is, we have done a ton of work. We've got a couple of videos. If you go to the Return Stacked ETFs.com website and look at any of our ETF landing pages, you will find content on the specific trend approach. But the quick and dirty is you are selecting across a wide variety of global equity indices, global bond indices, global commodities, and global currencies, and deciding what to go long and short based on the recent performance, on the recent trend. Positive trends, you go long; negative trends, you go short. And that selection process has a pretty neat characteristic, which is it's idiosyncratic. It's very different than just equities and bonds. It also has the unique quality of doing, when trends are really strong, they do their best. And trends tend to be strong when there's a bit of chaos in the market. So when equities and bonds aren't doing so well, it has historically shown to provide some great offset. So yes, it's not an actual factor. And factor investing is stock selection. We're not doing that. We've put that aside in this mystery factor. We cheated a little, and we've used the capital efficiency of futures contracts in order to stack this diversifying strategy on top. And we managed to stack those returns while not necessarily stacking that risk. And I presented this in the past. We all have, and we've found it quite interesting to hear the reaction that a lot of people, especially those that are in the value camp, value stock selecting camp, they feel like we're cheating, or they feel when they use it like they're cheating, that it's not real alpha. And the truth is that it shouldn't matter to us whether we get that outperformance by a traditional stock selection, or now that we have the ability to get exposure to capital efficient prepackaged solutions, whether we're doing it through a return stacked approach. It should make no difference. I know it's a bit of a mental hurdle. Talked about earlier, sacrificing some of those sacred cows. I think this is one of them that tends to be quite difficult to sacrifice. So again, it's a quite useful and a differentiated approach to try to beat those benchmarks. Okay, so that's
Rodrigo, I think
study number one. Yeah.
it's useful, I think, and I think legitimate to wonder why we feel that a trend following approach across a few dozen global futures markets and equities and bonds and commodities and currencies are likely to deliver more persistent excess returns than stock picking. And so just to double click on that for a quick second, I think we all subscribe to what some people call Samuelson's dictum, which is just the idea that markets are micro efficient, but macro inefficient. And what that means is that because 99.9% of all cognitive and computational energy and work in markets is around the idea of trying to pick the best stocks out of a universe of stocks, or pick the best bonds out of a universe of bonds, those types of activities are really hard because markets are really efficient in that space. There's actually a very small proportion of investors who have either the portfolio agility or the mandate flexibility to be able to seek excess returns through a global macro lens, by emphasizing certain equity markets over others, or emphasizing equities in general over bonds, or energies, or being short bonds, being able to go long and short, that sort of thing. That's a very narrow group of people in the market. And because of that, the alpha sources are not nearly so picked over. And for that reason, we feel that the opportunity of continuing to generate these systematic excess returns in the macro domain substantially exceeds the potential in the micro domain of stock picking. And that's why we continue to emphasize these types of strategies.
Yeah, that's a great point, Adam. At the end of the day, when you think about the big institutions, the pension plans, the advisors, and the amount of computational brain power that goes into trying to do better, they're all really focusing on, they have their set asset allocation, their 60, 40, 80, 20, whatever it is. There's not much wiggle room in that asset allocation, right? Especially if you're dealing with actuaries that require you to have some sort of estimate of future returns of the strategic asset allocation that you have. Those are the type of barriers that are unlikely to go away. And therefore, most allocators focus within the silos of small cap, international equity, large cap, bonds, high yield, private equity, and they try to pick better assets within those silos. Whereas this concept of allocating through indices, having maximal mandate flexibility, being able to go long and short as an overlay, provides, I think, a very robust and underserved environment that allows us, I think it will allow in the future for us to provide different return profiles that could stack on top. And of course, the capital efficiency of futures is key here. Okay. So thanks for that, Adam. And I think that leads us into the next case study. In this case study, what we're going to do is we're going to actually introduce a second factor or a second mystery factor. In this case, it's just a different style. This is a futures yield or carry strategy. And much like trend selects on those equity, bond, commodity, and currency markets, so does the carry selection methodology. And much like in the equity selection world, there are different styles. So you can pick stocks based on value, on growth, on quality, and so on. In the futures space, there are different styles as well. And this style, the futures yield or carry strategy, now instead of selecting based on the recent trend, what it's doing, it's selecting based on the amount of expected yield or carry that each one of these markets is showing at in this very second. There's multiple ways to measure carry. Again, Corey recently did a full webinar on carry that is available or will be available on the website. If anybody wants to reach out and tag us before we actually put it live on the website, we'll share that webinar video with you. But the idea here, again, the quick and dirty on carry is, if we want to use an analogy, it's the idea of, first of all, before the analogy, it's the idea of what you're going to get paid if the price of the underlying doesn't change. And if we think about it from the perspective of real estate, when you own a property, there are two components to the amount of returns you can make from buying a piece of property. The first component is the price appreciation of the land in the house. And the second component is the rental income minus the cost, right? So that's the carry. And that's the second part, is what we're going to focus on in order to select whether to go long and short these asset classes. If you think about it from when it comes to the futures yield strategy, we're not actually we're identifying the carry of each one of these asset classes, but we're not there to clip those coupons. It's not like we're identifying carry, which is, okay, that's 5%, we want to clip that coupon. It's not that concept. We're really a robust multiple carry signal strategy across these markets. We find that the likelihood of the underlying asset's price to appreciate in the next period is highly linked to the amount of yield that it has in any given period. And so carry as a proxy to price movement. And if we go back to that real estate analogy, you think about the rental yield. Let's give a hypothetical example here. Let's say that Chicago housing in the suburbs has a positive yield environment where you can buy a series of housing developments in Chicago. The yield's positive minus the costs. But then you look at Austin and you see that the yield that you can get on those rental properties is much higher than what you can do in Chicago. The likelihood there is that Chicago not only provides low yield, but also a downward returning or poor returning price appreciation of those assets. It makes sense that if we're looking at higher yielding markets in the rest of the United States, that there will be money flowing to those higher yielding properties, and therefore increasing the price appreciation of those complexes, those properties in the US. So again, the key here is looking at yield as a proxy for what to go long and short in this universe of equities, bonds, commodities, and currencies. So with that said, just one of the key things here is why do we want to focus on carry? Carry happens to be the second most popular strategy in the commodity trading advisor space, right? So we talk about different styles. There's fundamental, relative value, mean reversion. It's trend number one, carry number two. And the reason for that is that they have very low correlation to each other. So carry has low correlation to trend, and trend has low correlation to the S&P 500. This chart just shows the S&P 500 total return index versus the SocGen CTA trend index versus the Goldman Sachs cross asset carry index. And you can see that against equities, it's 0.02, against trend is 0.19. So very useful. Now, if we think about why carry, why trend, and why do we like these as stacks above the S&P to aim to beat the index, is because you should expect positive rates of return for taking the risk on the carry side and the trend side. But one of the things that you want to avoid is to go down when S&P 500 goes down. So you want to avoid getting hurt when it hurts to get hurt, as Cliff Astis always says. What I'm showing in this chart are the four major bear markets of the S&P 500. and then what the performance has been for both trend and carry indices here. And you can see that during the prolonged tech bubble, it was a 3-year period from 2000 to more than a 3-year period, 2000 to 2003, a 47% drawdown in the S&P 500, trend up 62, the GSAM index up almost 100%. So if you let these strategies to grow for many years, it has a higher likelihood of accumulating positive returns because they're indifferent. They're not, there's a 50-50 chance any given day of making a positive or negative return, regardless of what's happening to the S&P or the bond index. And we see the same thing during the credit crisis, which was a shorter bear market. We see a positive 32% return in trend, positive 5.5% return in the GSAM index. In the COVID crash, much more abrupt, much harder to kind of transition in and out of things, but still diversified enough that both trend and carry only lost a little bit. So that would hurt a bit more during that bear market, but not necessarily anything that would be devastating. And then the Ukraine war, the 2022 to May 18th, 2022 period, we see a similar outcome. A couple of months to allow trend to do its thing, and then negative 2.8% return for the cross asset carry. All right, so what's the setup? The setup here is going to be, in the previous example, we stacked 100% of trend. Here, we're going to be a bit more modest. We're just going to stack 25% in trend and 25% carry on top of the S&P 500. And the result of that outcome, and again, what we're stacking are those two indices. This is the excess returns that we're going to be stacking on top of the S&P 500. So the return to trend, the return to carry minus the cost of borrow. And the outcome here, what I'm showing is the calendar year returns from 2004 all the way to 2024. And what we see in terms, this is a key part, we talked about the benefit, the consistency of being able to say to yourself with your portfolio or your clients whether you outperform this year. What you can see here is that the blue line representing the S&P 500 right next to the return stacked case study number 2 here shows that most years there is a positive stack. Most years, you can pat yourself on the back and say, I was able to accomplish what I aimed to achieve. And we're doing this from a structural edge rather than security selection. You're getting all of your beta, your traditional beta, and you're stacking something new. Now, the question is, when you stack those carry and trend strategies, you're stacking those returns, how much risk are you stacking on top of that? And what's interesting here, it's because of the non-correlation, even though we're stacking these things on top and we're using that capital efficiency and leverage to do that, out of the 3 negative years here, 2 of them, by stacking, we were able to minimize the maximum losses here by a couple of percentage points. The exception being in 2018, which added to the underperformance by a couple of points. So what is the outcome of this case study? The outcome is, compared to the original case study in Y charts of 0.3, the outperformance is meaningful here. It's 3.2% annualized. The second thing is the consistency. How often in this case study did we see outperformance versus the S&P 500? In 18 out of 21 observations, right? Where the median mutual fund in that previous study only outperformed 11 out of those 21 years. And then lower risk, you see the benefit and because of the structural differences, there's a likelihood that we're going to see a lower drawdown when you include this on top of the S&P 500 index. Okay, I can't emphasize how, just to think about these outcomes here, to think about what you can do in a completely different way. Like, you get to stick to what we've all been told, that it's really difficult to outperform the index. Passive indexing is what you need to do. That's all you should try to strive for. That's great. You get to do that. You get to keep that ethos and then do something else on top. We talked about a couple of things here, carry and trend, but the question is that the only things we could stack? Now, before I get into that, I'm just curious, Adam, any questions? Did I miss anything that you might want to?
No, I'm answering some things in the chat while you're going, and I think you can continue. Thanks.
Great. So when we think about, we've highlighted a couple of stacks, but when we think about return stacking, really the world is your oyster, right? And you can identify any sort of excess and any sort of alternative strategy that you think is useful to stack on top of your traditional betas, maybe more about, I don't know, market neutral or relative value or event driven or equity long short. Maybe you feel more comfortable with those types of stacks. you can, with the ETF lineup right now and the options available to you today, you can actually stack any one of these on top of your S&P. And the way you need to think about these stacks is you want to think about the excess returns, right? What you're going to be stacking is not the total return of that strategy. What you're going to be stacking is the excess returns above the cost of borrow. And in the futures space, when you're using futures contracts, in order to get that capital efficiency, there's also on the website, you can find more information on this, but futures are super capital efficient. They are one of the cheapest ways, if not the cheapest ways, to borrow at times at an institutional level, where you're looking at SOFR plus 40 basis points, 50 basis points. So it's incredibly cheap to do this. So as long as you can cross that hurdle with whatever alternative strategy you want to stack, it's going to be accretive to your portfolio long term. And if you think about these as slicing through these bar charts here, you see the gray bars. That represents the cash yield of all of these indices here from HFRI. And then you can see the disclaimer here of where I got this data from 2004 to March 2024. When you slice through these and you just get the excess kind of whipped cream on top of excess returns, now you have all these building blocks that you can play with in whatever way you fit. And with these building blocks, plus your S&P 500 passive exposure, you can now choose your own adventure. If you like gold and you like relative value, you can choose to stack those two. If you like equity long short and systematic global macro, you can stack those on top. If you like trend and carry like I do, you can stack that on top as well. Again, these are all super flexible. And if you don't know how to do it, or if it's not super clear to you, we are available. You can go to the site, returnstackedetfs.com, book a time. There's a calendar option there for you to find a time to chat with our sales team. And we'll be happy to help you conceptualize how these things might help in the future, right? But obviously, at the end of the day, we have to ask ourselves, what do we think is more probable here going forward, right? I would assume that a lot of us are afraid of a possible low return environment in the next decade, given how well it's gone for us in the previous 10 decades in equities. So is it more likely that we are going to find in a low return environment excess returns above that index by stock selection? Or is it more likely that we can find a diversified basket of investment strategies with excess returns on top of cash that we should stack on top? I venture to say that we're likely to see more of the latter than the former. All right. So ultimately, let's not fish in the same pond as everybody else. You see the benefits of separating the alpha opportunities from the beta source, stacking those alternative alphas or alternative betas on top. You can strive to minimize the risk of manager style drift. We've seen how painful it has been for value investors to stick to that value factor all these in the last decade, especially. You have, given the fact that a lot of the alternative and absolute return things that you can stack on top tend to provide returns 7 or 8 out of 10 years that you can stack on top, there's a much likelihood of consistency there and less style drift. And then you can explicitly control for the amount of active risk you want to take. We first started with 100% stack of trend, then we went to 50% stack. You can go as low as 10% stack, maybe enough to add a few basis points just to get over some sort of savings hurdle, right? You get to control the amount of volatility that you add to your portfolio and the amount of style drift or tracking error that you have. All right, so that's it for the case study portion. What I'm going to get into right now is a couple of prepackaged solutions that we currently offer. Adam, anything you want to add up to this point?
No, I'm just cranking away at answering the questions.
Okay, maybe we could cover a few of those at the end of the presentation. Okay, so we talked about these concepts, these case studies. Now let's talk about when the rubber meets the road. What can we currently use? What's out there in the market that we can use in order to help us achieve those types of portfolios? As we talked about in the beginning of this presentation, we offer prepackaged solutions where if you buy any one of our ETFs, we offer $1 of something of a traditional beta, and then $1 on top of that of a diversifying stack. Okay, so you get 2 for 1 in your portfolios. And I'm going to show you what that may look like in a couple of slides. But the 4 ETFs that are currently available We'll start with one that's slightly different than the bottom three. The first one is the Global Stocks and Bonds ETF, ticker RSSB. RS is Return Stacked, S is Stocks, B is Bonds, RSSB. And that one has a global equity base. And then stacked on top is a laddered bond portfolio that is similar in duration to that of the US aggregate bond index. That allows you to create space in your portfolio in order to add any alternative that you think is useful to your portfolio or your business. And that has around $168 million, give and take. The next three have the second stack are going to be more in the managed futures space, both trend and carry. And so RSBT is Return Stacked Bonds and Trend. And the bonds we're trying to replicate the broad US aggregate bond index. And then we're stacking on top a full managed futures trend strategy. That's at over $90 million right now. The RA is a Return Stacked Stocks and Bonds. That's US equity plus managed futures trend. And RSSY is US stocks plus managed futures carry. And as of July 6th, these are the numbers of AUM here that we currently have. Those have grown since. It's pretty neat to see the diversity and the use case across the lineup. So just quickly to highlight the US stock to managed futures ETF, again, US equity and then managed futures strategy, $1 of one and another dollar of the other. Why is this useful? We can just take a visual shot of why it's useful, right? You got the light blue line is US bonds, the dark line is US equities, and the green line is the managed futures trend index. This is the SocGen CTA trend index. And what you can see here is that all three of them offer returns. It's equity lines that go from the bottom right to the top right. They offer returns at different times in different ways. Now, again, the green line offers really problematic returns as a standalone. If you're selling your favorite equities and selling your favorite bonds to add this to your portfolio, this addition by subtraction, it can be painful during periods of flat returns. But if you stack that on top, you get a much different outcome. So that from the stacking perspective makes sense. Once again, highlighting here the worst for equity market drawdowns versus the returns to US bonds in light blue and the returns to the CTA trend index in green. You can see that it can act, or it has historically acted for structural reasons, as a good offset to equity bear markets. Now, I've gone through the idea of carry, same thing here, US stocks, 100%, US futures yield for 100%. And once again, that green line is very different than trend. It can be frustrating as a standalone if it underperforms equities and bonds during a decade, like we saw in 2010s. But if you're stacking it on top, lots of value, right? So the correlation here between futures yield and US bonds is very low. And you can see visually why that's useful. And then in terms of the worst periods for equities, you can see that it has either positive or flat returns during the worst periods. All right, so how can this be applied to your portfolio? So there's two ways. We have been talking about 100% equities, and I'm just going to briefly cover a 60-40 here. Assume you start with a 60-40 portfolio and you want to stack trend on top. This is now a super easy approach where you can sell 20% of your equity portfolio, and you're going to buy with that money 20% of RSST. And when you do that, what happens is you get your stock right back. You get that 60% full exposure to the S&P. And then you also, this is what you're going to see your clients or yourself, you're going to see your 40% in bonds, you're going to see another 40% in equities, and you're going to see 20% in RSST. But that prepackaged solution, that 2-for-1, actually, when you x-ray and you put your x-ray goggles on, what you're actually getting is 60% equities, 40% bonds, and an extra 20% of trend. In the examples that we've given above, which is just the S&P 500, that's another, just as simple as well, sell 20% of your stocks, buy 20% of RSST, and when you get there is 100% of stocks and a 20% to trend. Similarly, for RSSY, I won't go through it again, but now it's green, it's not blue. Green represents carry, and you're doing the same approach to stock selection. Right, so now you got the practical implication, a couple case studies We really want to drive this home. There is a new way. There is a better way. We're incredibly excited about it. And we've done a ton of work on providing videos, webinars, presentations, written content for everybody to get up to speed. And of course, we have the bright minds across both Newfound Research and Resolve Asset Management to help you along in whatever capacity we can to create better portfolios for you and your clients. So now I think we can open it up for some questions. Maybe Adam was able to choose some that made sense as I scroll through the glossary of terms and some of the disclaimers.
Yeah, one question that keeps popping up is kind of two, and that is the question of whether we want to launch products that exclusively stack alternative strategies. So for example, 100% trend, 100% carry, which would allow people to, for example, own other diversifying core strategies like leveraged global risk parity or a levered stock bond allocation, and then layer the 100% trend, 100% carry, or et cetera, strategies alongside. And another was whether we plan to offer stacks where the core allocation is to global stocks or global bonds. I don't know if you want to speak to those.
Sure. Let's talk about the first concept, right? Obviously, we can stack whatever we need to stack that has capital efficiency and so on. And the reason we've chosen to start anyway, you never know what comes in the future. We are going to continue to evolve this business and continue to add valuable stacks. But to start with, there's two issues with or approaches to stack. Number one is we want to be able to provide some of the basic building blocks, right? We do want to be able to provide the biggest and most basic building block of US equities and bonds because they represent the largest market cap. Even in global equity indices, it represents the largest portion of the portfolio. So the number one is we wanted to provide easy ways to swap out what the majority of investors invest in and swap in the same thing and get your exposure on top. But I think there's a strategic reason why those make sense as well. And a lot of it has to do with tracking error, right? A lot of it has to do with that line item risk that you will see in your portfolio, or if you're an advisor, the line item that your clients are going to be poking you about all the time. We've been at it, Adam, for almost 20 years now, trying to convince people to have pure exposures to alternatives for all of the reasons that we talked about, right? It just makes absolute sense to have non-correlated return streams. But when the client sees a 5-year period of single-digit returns that is whatever, non-correlated, reducing portfolio volatility and reducing drawdown, nobody seems to care that much. What they care about is like, why is that one line item hurting us so much? By stacking the alternatives on top and having those prepackaged solutions, the line item risk gets drastically reduced. And if you go to our website on what is return stacking, there is a chart there that shows a rolling returns of what happens when you make room in your portfolio for an alternative versus what happens when you stack it on top. And the difference is massive, it's drastic. I think we underestimate the impact of the behavioral flaws in humans. And that I'm not even talking about the layperson. I'm talking about veteran CIOs of large institutions that have to report to boards that see this solution as a much better approach to mix in, to provide that beta and mix it in with the alpha as a prepackaged solution so that we can minimize that behavioral error. So I think that's why we're launching betas on top of alphas rather than alphas on top of alphas to start with. The second question, Adam, remind me was?
Yeah, the second question was, are we going to add any global equity core stacks or global bond core stacks to the lineup?
It's something that we're thinking about day in and day out. It is, again, even within the global market cap indices, US equities continues to be 60% of that. So if somebody currently wants to get that exposure, you can certainly do it with the RSSB, which is already global. But with the other stacks, we're trying to capture that largest chunk of everybody's strategic allocation, which is the S&P 500. As we fill that lineup with the S&P 500, we are seeing some demand for global. Now, let's be honest, we probably have very thoughtful advisors and investors here. Our sample size is very unique. I don't think if we pull from the average advisor globally that people are clamoring for diversification outside US equities. So we also have to make some commercial decisions as we start this project of return stacking. to satiate the demand that exists today, I am confident that as we move forward, we will be able to provide that global exposure down the line.
Some people have asked where they can look for funds that help them get a better intuition about the character of carry strategies. So might be useful to address that. The reality is the carry exposures are often run alongside strategies in large CTAs. And as Rodrigo highlighted, carry is the second most mentioned and allocated to sub-strategy within the managed futures universe after trend. There are not, to our knowledge, dedicated carry strategies. There are some dedicated carry strategies on the private side run by large managers that many of you will probably have heard of, that you can find in managed futures databases, but they haven't been run in public mutual funds. We've been running our carry strategy as a sleeve of a publicly available fund since 2020, and we've been running it as a commingled sleeve within our other strategies since 2017. So we've got a pretty good grasp of the quality and character of carry, of diversified carry, the way that we deploy that in the ETFs, and we'd be happy to go through that in greater detail with anyone who wants to connect with us.
Yeah, great answer there. And I think the time has come for carry. I think you, Adam, and me have been very excited about educating the masses on this. I think it's the next best thing on the future side, aside from trend. And it's been difficult to really get out there, but we're satiating some demand, and we hope that continues to grow. This leads into another question that I'm reading here, which is some people are surprised when they look at the daily variance of one of our ETFs versus the S&P 500, and they seem to have been surprised by how much variance there is between S&P and the return stacked approach. So the way you need to think about this is you have an S&P 500 index that has a volatility depending on the period of 15 to 20%. And then you have, let's say, a carry strategy that has a volatility of around 10%, right? If you simply add those up, 15 plus 10, it would be 25%. But thanks to the benefits of diversification, what tends to happen is a lot of that variance gets reduced because if one zigs when the other one zags. That's the whole point of being zero correlated. But it doesn't completely eliminate it. It's not a one-to-one. When one thing's up 2%, the other one's down 2%. A zero correlation means sometimes they're both up, sometimes one is down, one is up, and sometimes both are down. So you will see on a day-to-day movement, you will see sometimes up, down. And the periods that are going to be most volatile are when it's up or down. This is, if you think about it as a standalone strategy of 10% volatility, what can you expect from any 10% volatility strategy with a relatively normal distribution is that you're going to expect on the right side of the distribution and the left side of the distribution movements on the 2 and 3 standard deviation event of plus or minus 20 or 30%. Let's just say for just simplicity's sake, you have a Sharpe ratio of 1, volatility of 10, return of 10. And what can you expect in terms of the worst or 3 standard deviation period? It's 10 minus 10 is 0, minus 10 is negative 10, minus 10 is negative 20. So you can expect that strategy at some point in the future to exhibit a negative 20% return. Now, because of the non-correlation to equities or bonds, if you were to match that up, their drawdown, that strategy's drawdown may not necessarily coincide with the equity market's drawdown. So you will see periods, this ebb and flow at the worst case where this strategy either adding over a full period an extra 20% or subtracting some at the worst, 3 standard deviation event, which is quite rare, subtracting 20% momentarily, right? But as you look at the data, going back to all of these strategies, most years as they meander, the volatility does expand a little bit versus the S&P. Most years, as we've shown before, the overlay strategies and these alternative strategies tend to provide positive returns as that's their mandate, right? To be up most years.
Great question from Scott, who's been looking at our ETFs on Morningstar and noticed that we've got four funds across three different categories, and is wondering whether there's anything we can do to consolidate them into a single category. And the answer is, sadly, we have very little control over how Morningstar chooses to organize their funds and our funds into different categories. We have made suggestions. And also, because the funds are a little bit newer, they don't have as much live history to go by to help them with their categorization. So I expect as we get a longer track record and the strategies exhibit their intermediate to longer term character, then they'll more naturally fit into a consolidated category. So we look forward to that as well.
There's also been some, go ahead.
There was some questions about the character of the carry strategy in particular, and concern that, those who've been around a while may be familiar with the concept of a carry strategy in the context of currency carry, which typically was implemented by borrowing in low interest rate currencies, historically like the yen, for example, and more recently the US dollar, and investing in higher yielding currencies, typically in the emerging markets or higher yielding developed market currencies. And that has a very strong cyclical component, which means that historically it has hurt when it hurts to be hurt, because the drawdowns of those old-fashioned carry strategies do tend to correlate with equity drawdowns. In contrast, the carry strategy that we deploy and that we've been running internally for many years runs across all the different futures categories. So equities, global bonds, global currencies. And for that reason, we don't observe at all that same character. It's a coin flip whether the diversified carry strategy is likely to be up during a period when equities and or bonds are down, and vice versa. If anything, the diversified carry strategy seems to have exhibited historically more of a propensity to be a nice offset during periods that are more difficult for equity and bond investments.
Yeah, what we've seen is we tried to do an analysis of which economic regimes carry does better or worse at. And what we found is that it's equally likely to continue to chug along across all four of the traditional economic regimes, which is inflation up or down, or growth up or down in the intersection of those. So it's one of the reasons why Adam and I have loved that carry strategy for as long as we have. It's a pretty robust strategy across most market environments.
We're sneaking up on the hour here. Maybe I'll address a question that we've gotten in from several people about when the Return Stacked suite of products will be available on the different platforms. Someone mentioned LPL, a few people mentioned LPL in particular. And I can say that we're in advanced discussions with the LPL team, who've been extremely constructive in our conversations, and we anticipate having some success in bringing the product suite to LPL advisors in the very near future.
Yeah, still in conversations, but we're confident they're going positively well. But just broadly speaking, platforms are going to be a little taken aback by the fact that we're so honest, transparent, and explicit about what we're doing. But at the end of the day, all of these platforms have, most of them anyway, have exposure to managed future strategies that are already using leverage in order to provide their strategies. And we are no different than that. The only thing that we're doing is being explicit about it. So you get a bit of a sticker shock, but then when you get into conversations with these platforms and explain that we're no different, we're just being honest about it, it tends to progress those conversations. And those are talks. If you're an FA out there, those are the type of things that you can address to on your end if you want to talk to your platform that you're in right now. But given that we're at the hour, just thank you everybody for sticking with us this long. We really appreciate everybody's support. If you want to have a conversation directly with any one of us, the best thing to do is to go to the Return Stacked ETF site. On the top, there's a contact us button. There is a scheduler there. Pick a time. Do reach out. Let's just, even if you're not sure whether you're ready to invest or you just want to ask some questions, let's have a quick half-an-hour meeting. Let's get to your objections and worries and see if return stacked strategies and ETFs are right for you and your clients. With that said, goodbye. Thank you so much. And thanks for sticking around, Adam. Any parting words?
Nope. Thank you very much. Great job, Rodrigo. And look forward to speaking to anybody with any questions.